I'm Dan Broccoli. I help out with content here at Jump. Liam, why don't you tell us a little bit about who you are and what you do at Jump?
Yeah, it's a good question. I am the head of insights here at Jump, which is an ambiguous name and title. But what I am responsible for is really figuring out what to do with this golden source of data that we have. We have over 10,000 advisors on our platform now, and that's growing by almost 2,000 advisors per month. And
Yeah, I heard
exponentially.
over 14,000 now. So it's
Okay, so
yeah, yeah, yeah. It's
every
great.
day I'm outdated on the
Yeah.
number of advisors that I reference, but I think just a month ago we were at 9,000. So we're growing faster than we ever have before, which is very good news. It also means that we're having more meetings happening within the Jump system. So more Jump note takers are joining calls every day, more every day than they were the day before. That results in us currently having access to about 1 million anonymized and aggregated transcripts of client and advisor conversations. Insights is an initiative that we're bringing to life within the product. So, our question when we started at Jump, and I wasn't here, but the founders, their mission was to give back advisors 90% of the time they were spending on admin related to the meetings they were having with clients. They were only spending 25% of their day speaking to their existing clients or prospecting future clients. To a large degree, we've succeeded. Over 60% of our users now save over an hour per day. All of our users save time, but 60% of them are saving 5 hours per week or 250 hours annually. So our question has shifted as a company. It was, how can we give time back? Now that we've given this time back such an immense amount, it has shifted to how can we optimize the time that we've given back? And that's what Insights is all about. And Insights, in essence, is really just conversational intelligence. We're having a conversation right now. If we were an advisor and a client, if I was the advisor and you were the client, Daniel, there are things that I would want you to do. I would want you to reallocate your portfolio or not liquidate to cash or introduce me to your spouse or your children. All of these actions, all of these behaviors are what we're trying to help advisors succeed in. And so the way we're doing that is providing insights about their conversations, the signals that lead to behaviors. For instance, we did a piece together on the Great Wealth Transfer. What we found was about 20% of the time when an advisor proposes a recommendation to a client, regarding a wealth transfer of assets, about 20 to 30% of the time it succeeds. But we found if the advisor does 4 core, I'm going to call them variables, conversational variables, if they ask the right amount of questions, if they ask them at the right point in the conversation, if they spend the right amount of time on that conversation, and if they use the right persuasion strategy, they can increase their likelihood of success by 3x. So really profound, really, really relevant. So that's what we're trying to do is find those variables and then play them back to our users within the experience itself. Let me pause that.
Yeah, no, that's terrific. It's such a huge treasure trove of data, and it's a matter of like how do we use that? And I imagine there's a lot of experimenting and sort of developing statements that goes on with this because it's all new. I mean, having this kind of data to figure out how to help advisors grow, it's great.
Yeah.
Well, let's jump into what this looks like in real life, and let's look at an actual example of you looking at this anonymized, aggregated data to try to find some answers to help advisors in their conversations with clients.
Yeah, let's do it. A recent initiative that we have just completed is this look into the current state of alternative investments. Alternatives have been gaining a lot of traction recently, very recently because of the volatility in the market, and over the past 5 to 10 years because the sector within the industry has been expanding so much. The introduction of new types of alternatives, private credit, private equity, which are now available not just to the ultra high net worth, but the high net worth, the mass affluent, even some retail If you go to SoFi, you can get yourself some alternative assets. But this has created a frequency of discussion around alternatives to a degree that we haven't seen before. So we wanted to do a deep dive into how are advisors talking about alternatives? How are clients responding to the conversations about alternatives?
Mhm.
Are people bullish or bearish? What do we want as advisors within the community to inspire our clients to do regarding alternative assets? So,
So when you're talking alternatives, and I think we all have a general sense of what alternative investments are,
yeah.
but specifically, how do you define alternatives?
Well, I think the industry defines alternatives as an asset class that it provides some sort of diversification away from, or macroeconomically away from equities, fixed income, commodities, currencies, all of the other asset classes that have been defined in the past.
Mhm.
It is private equity. It's exposure to an asset that doesn't follow the same beta, right? The market movement, but there is still the capture of reward that is also not associated with market movement. So that's really what you're trying to do when you invest in an alternative, and why you position them is there's a promise of almost equal or greater rewards than compared to the market. So you're 8 to 10% annually, but
Mhm.
the risks are not associated with the same macroeconomic risks that impact the market. So it's
Mhm.
a way to diversify while still maintaining that reward or that ROI that you're seeking.
Great, thank you.
Let me pull up my screen here.
Yeah,
We
pull up the
created a
deck. Let's
report.
see it. Get into the data.
So we started by first just looking at some of the level one statistics or metrics that we can derive through conversational intelligence. So we looked across all asset classes that we could identify at a high level and wanted to know how frequently are advisors discussing them? And we looked over the last year and broke this into 3 periods, each divided by 6 months worth of time. So in June of 2024, you can see the lightest color on this bar chart represents how often advisors were discussing these different asset classes in a portfolio allocation conversation.
Mhm.
So in the case of equities in June of 2024, advisors brought up equities, or advisors and clients had a discussion about equities in 63% of all portfolio allocation discussions. That grew to 73% by December of 2024, and it ticked back 1% by June 2025. So we could see the ebb and flow of discussion frequency by these asset classes. Real estate, annuities, cryptos, you can see those are a little more volatile.
Mhm.
Real estate, crypto, and gold really follow a news cycle. So they ebb and flow based on if interest rates are moving, if the Fed is speaking, if crypto is bursting. The headlines really drive those assets. Alts is not in the news, rarely ever. It's driven by the advisor, and we'll get into that. But you can see how steadily it's been growing. So this was our first major takeaway. Alternative investments have experienced a 50%, 56% increase in the proportions of meeting where they've been discussed over the past year. That's the fastest growing asset class in terms of frequency of discussion. And it's almost being discussed in about a quarter of all portfolio allocation discussions. That
And
was just at 15% last year, and probably before that, even less. So you can see the advent of alternatives is arriving.
it's huge. So, I mean, I'm going to call for a little speculation, and with the caveat that this is just speculation, right? But it's an interesting conversation to have. I mean, do you think some of this is due to the fact that they're just much more accessible than they ever have been to a degree? Is this? I mean, I also wonder if it's an interesting conversation for the advisors themselves to have. I mean, equities, it can be a pretty basic conversation, whereas alternatives there's some complexity there that's an advisor I would imagine could add a lot of value to that conversation where they might not be able to add that value to some of the more straightforward conversations.
I think you hit the nail on the head. You can see the right-hand side of this chart. Annuities, alts, crypto, and gold. Those are the most complex assets. So they come up less frequently than the ones that are really easy to talk about.
Mm.
cash, equities, bonds, real estate. Those all have like a standard rate of return. And we'll get into that a little bit more later. I think this increase in alts from speaking to advisors is really driven by this push within the industry, the accessibility, as you mentioned, and also wholesalers going out to advisors and pushing alternatives as the next hot product.
Right.
Right? This is the way to diversify. People are seeking this. We have the answer to it. We have more accessibility than ever. We have more diversity just within the alternative space. Alternatives used to mean one thing back in 15, 20 years ago. Now it could mean 100 different types of products or funds, so on and so forth. So definitely, I think it's an industry push really brought on by wholesalers that are pushing the products. And I won't get into the reasons they're doing that, but I think it comes with some sort of profitability at their firm level or maybe at the advisors.
That makes sense. Thanks for indulging me.
So we can move forward, and I think what you mentioned before, the complexity really seeps into this part of the discussion, right? You can see here, the second thing we looked at was not just how frequently they are being discussed, but who was initiating the discussion. That right-hand side, annuities, alts, equities, bonds, these aren't the most complex assets necessarily. Some of them are, but they're the most boring, I would say, right? And this right-hand side is uh, frequently brought up by the advisor. So in the case of alternatives, 86% of the time that alternatives are discussed, advisors are the ones that initiated that discussion. In comparison to crypto, where almost 50% of the time the client brought it up. That makes a lot of sense, right? The crypto, real estate, gold, those are the headline driven assets. The clients are bringing up the things that they see in the news, not necessarily to have a fruitful or meaningful conversation about them, but because they saw some sort of headline and want to investigate or explore with who they believe to be the financial expert in their life. Versus bonds, 92% of all bond conversations are inspired by the advisor. That doesn't surprise anybody, right? I don't think a client has ever said, you know,
Talk to
let's,
me more about these bonds,
yeah,
these exciting bonds.
tell me about those T-bills.
Yeah, yeah.
So they're interested in the appealing assets. That doesn't mean that they're investing in those appealing assets. It's just meaning that they're the ones that are inspiring that conversation. And the right hand side you can see is more of a diversified portfolio. There's an
Well,
annuity, an equity, an alt, and a bond.
yeah, I mean, and bonds are so much more straightforward than crypto, where I mean, crypto is in the paper for sure. It's also questionable. I mean, people have philosophical questions about the value, the inherent value of crypto. And so I think when you go to your financial advisor, that's like the trusted person you can go to like set me straight about this sort of thing,
Yeah.
right?
I think so. Yeah, they're really relying clients are relying on their advisors to bring up the boring stuff,
Mm.
right? It's like you rely on your doctor to tell you to eat healthy, to maintain your actual health. You're not relying on your doctor to tell you how to have fun, right? They're paying you to bring up and to talk you into the boring stuff, the alts, the bonds, the annuities, the equities. That's the job of an advisor. But client, that doesn't mean clients don't want to get on the call and say, "Did you see what happened with, Trump coin or
Right.
or Ethereum?" So this is really interesting to me. So you can see the slide before. 25% of portfolio allocation discussions, we're talking about alts, but of those discussions, 86% of them are driven by the advisor. So that works perfectly into the next slide. So now we know the advisor is the one bringing up alts. Then I wanted to see what are the advisors actually saying about each asset class and specifically alts. So on this graph, you can see the advisor has three options. They can tell the client to decrease exposure, increase exposure, or maintain exposure. This is where we really started to get excited about this analysis. Alts was a major outlier here. In 98% of conversations where a recommendation about alts was made, 98% of the time, it was either increase or maintain exposure. Only 2% of the time was it decrease exposure. So this is, from this perspective, the asset class that advisors are most bullish on as of June 2025. If you look at something like cash on the other side of this spectrum, the right-hand side of this graph, you can see 32% of the time the advisor said to decrease exposure. This makes sense. Cash is at an all-time high in the United States, exposure to cash.
Mhm.
That's largely driven by the volatility of the market during this political turmoil and the tariff mania that's been happening. People have been trying to find a safe haven within an asset that produces a 4% return, especially in a high interest rate environment. However, alts is this just this complete opposite. It's the ability to diversify. It's the ability to capture a return without being exposed to the volatility, I believe. So
I've
that
won.
is, yeah, go ahead,
Well,
Dan.
I wonder, and I don't think that I don't know that we have the data to really look into this, but I do wonder what percentage of that is, I mean, what the breakdown of net worth is for that and the
Hmm.
clients, and how that would differ with a high net worth client versus maybe a mass affluent client, and like how that would fall.
That's a great question. We can look at that from the perspective of the advisor's book of business to see, high net worth advisors versus maybe mass affluent advisors. We're still working on connection to client data.
I
But that's
suspect,
a
and I don't know, but obviously I suspect that the high net worth and ultra high net worth, the putting more into private equity would make a lot of sense at that point, right? You've already got your base in equities, and then you're looking for
yes.
something to really diversify. Yeah.
When you look across the different segments of clients, the higher you go, family offices, your ultra high net worth, your billionaires, your 100 millionaires, those are the ones with most exposure to private equity, and alts, VC, any type of alternative. They have the highest exposure as a percentage of their total portfolio. And we spoke about this at the beginning, it's largely due to the history of accessibility into this asset class. Now that that's changing, you can see here it's representative of this change that advisors are now introducing an asset class that hasn't been accessible. And when it hasn't been accessible, there's less opportunities to say decrease exposure because these people don't have any alts to decrease. So that makes sense, right? But
Mhm.
I think this is still just an incredible representation of how bullish advisors are on alternatives. Annuities were the second best, but you can see 62% of the time advisors were saying to maintain exposure to annuities. Annuities is binary, right? You don't reduce an investment in an annuity. You either buy an annuity or you don't,
Right.
right? So once you have one, it's largely maintaining. But 53% of advisors said to increase exposure to alternatives. That is almost double the next best increase exposure percentage for an asset class. So very interesting. You can see equities, 68% of them, of advisors, are saying to maintain. That's the second highest only to gold. That's largely, I think, due to the fact that gold and equities are both at all-time highs. It's really hard to talk somebody out of it, right? You
Hmm.
don't really want to sell equities. However, it's hard to talk people into buying at all-time highs. So a great chart here from June 2025.
Yeah, this is fascinating.
Okay, so we've seen the frequency of alternatives being discussed. We know they're largely being brought up by advisors. And when advisors are bringing them up, they're saying buy, 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 right? It's the most bullish asset. When we look across, if advisors make a recommendation, typically it's buy, are clients following that recommendation? Are they committing to the recommendation that the advisor proposed?
Mhm.
That's what this chart is. So in the case of cash, if an advisor tells a client to buy cash or to increase exposure, 75% of the time, that client is listening to the advisor and they're saying, okay, let's increase exposure of cash. That's the number one asset class. The number or in a rank of how easy it is to talk a client into committing to a proposal,
Mhm.
cash is first. Alts is near the bottom. So only 37% of clients that heard an exposure, or I'm sorry, heard a proposal about exposing to alternatives, either buy, sell, or maintain, listened to the advisor. Only 37%, meaning it's much more difficult to talk a client into buying or selling alternatives than it is many other asset classes. You can see annuities, alts, and gold and crypto are at the bottom of this list. And I think it's because those are the four most complex asset classes on our list that we analyzed, right? Annuities is very hard to understand. If I want you to buy an annuity, I have to describe the value prop of an annuity to you, which is very difficult because it's a very complex asset. If I want you to buy an alternative or invest in an alternative, I have to describe the risk and reward portfolio, what you're actually investing in, understanding the macroeconomic, microeconomic risks associated with that investment. It's difficult. And to your point before, because this is a newer asset, these advisors are being exposed to it for the first time as well. Maybe they're not as polished in their value proposition of why to invest in an alternative. So it's very difficult. The
Well,
client
and
agreed to invest 37% of the time.
yeah, and I mean, as you mentioned before, the sort of swath of types of alternative investments is so large that like dialing in on that risk is challenging because there is such a breadth of offerings there. So
That's true.
homing in on that is tough for the client, I would imagine.
I agree. And for equities, it's really easy to understand, especially when most equities that you're buying are just ETFs, how
Right.
the market moves.
Here's the
Hey,
market. Take a
yeah,
look. Here's the graph, right?
yeah, 7 to 8% over 40 years,
Yeah,
right? That's what you're buying into. Here's the standard deviation of risk, 16, I think, percent, meaning it can go up and down in either direction any given year. But over 40 years, this is what your return is going to be. For bonds, it's even easier. For real estate, I mean, not that you can predict the market, but it's got a historical outcome of 3.7% annually. For cash, it literally tells you the APY. It can't get any easier to explain the return of an asset. The risk is zero, essentially. The interest rates could change, and so your APY could go down in a given year. But if you're putting a lump sum of cash into a high yield savings account at 4%, you're going to get 4% at the end of
right.
the year. So
I'll be curious to see in the next few months what happens to bonds, if that changes at all in terms of the likelihood of investment and the risk, et cetera.
okay, we'll have to do a deep dive into bonds.
Yeah.
Okay, so we'll jump into this next part. The thing we looked at after we had a good understanding of how alternatives were being discussed, how frequently, how the advisors were positioning them, was does the client's outlook on the market and the advisor's strategy to persuade that client have any impact on whether or not the client would invest in an alternative?
And
Here's what.
like, let me just pause and say how cool this is because this is the kind of data that just was not available before, and so
Mm,
this is a really like wonderful insight that Jump can bring that just hasn't been available before. So just want to, I mean,
agreed.
the industry reports, that have looked at this previously are
Mhm.
typically take ages to come out. They're
Yeah.
very expensive for people to buy. So this is just neat that you're able to look at this.
And the thing about the industry reports from the past is they're surveying clients to say, hey, are you bullish, bearish, neutral? It's over different time periods. What we're getting is a live look. The AI is determining through this conversational intelligence, is the client on the call confident about the market, cautiously optimistic, neutral, uncertain, or concerned?
Mhm.
The AI is making that determination based on the things the client's saying it, how they're behaving. So that's very cool, right? That didn't exist a few years ago.
Right, because
Um,
the client can later on interpret their own, they can sort of do an interpretation that
yes.
might not be really accurate to their in call attitude, right?
Exactly, exactly. Oftentimes when we're surveyed, we either knowingly lie because we want to be perceived as our ideal self,
Yep.
or we subconsciously just don't understand the reasons that we do things. And it's really hard to ask somebody, how confident are you about the market, 2 months ago? And then even if they were, accurate about their level of confidence in the market, that is different from person to person. Maybe you and I actually have the same market outlook, but I describe mine as neutral and you describe yours as confident. There's a lot of misinterpretation when we are asking people to answer the questions about themselves rather than using AI to, standardize and determine who's confident to concern. So here's the output. Um, this is client market outlook impact on client recommendation acceptance rate. What that means is if the advisor made a recommendation about any asset, not just alternatives, but cash, alternatives, equities, bonds, so on and so forth, how likely was the client to accept that recommendation and commit to it? And we segmented it by those 5 different market outlooks. So if a client is confident about the market, and this makes sense, almost 60% of those clients accepted the proposal of their advisor. So the advisor would say, you should buy an alternative or you should move out of cash. If I'm confident about the market, 60% of those that time, I'm saying, you know what, let's do it. You're right. I trust you, advisor. Let's go with your recommendation. If I'm concerned, the right hand side of the spectrum, only 45% of the time, I'm accepting, listening, or committing to an advisor's recommendation about what I should do with an asset class. So this was really interesting. It confirms a suspicion that we've probably had, but it shows us the real data. Here's the difference in likelihood. So what this can tell you right away is if our AI is picking up on the confidence of a client for you and playing it back instantly, saying, hey, this client is confident in the market or they're concerned, it could tell the advisor whether or not to try to engage in a product conversation. Maybe you should not propose to invest in an annuity today if the client is very concerned, or at least try to overcome their concern and
Right.
change their perception of the market before you make that recommendation, because your odds have already been diminished by almost 20% if they're concerned, regardless of how good you position that asset, regardless of how well suited the client is for that asset. If they are concerned about the market, not the asset, just the market in general, your odds have already been diminished.
So yeah, and so at that point, maybe you begin the conversation about the market, and it's a more reassuring conversation if that's where you want to take it. That makes a lot of sense.
Exactly. So again, one of the things we're productizing is that live client sentiment to the advisor to say, hey, your client, based on our AI interpretation, here's their index, on this scale of confident to concerned, to allow them to see that insight and to make decisions based on it. So if we take this one step further, this is one that is a little interesting, but it's the client recommendation acceptance rate based on the number of strategies that the advisor employs. So a strategy is a unique persuasion strategy. If I want you to invest in annuity, Daniel, I could say, hey, this annuity is right for you because I have clients just like you that invest in it. That's social proof. I'm trying to talk you into it by saying other people just like you are invested in it. That's
Right.
one strategy. If I then say, also, if you don't do this now, you may never have the opportunity to do it. That's a second strategy known as employing urgency. So those are 2 persuasion strategies. And what the data tells us is after 2 persuasion strategies are employed, there is a drastic reduction in the acceptance rate of clients. If an advisor makes a proposal, a recommendation about an asset, that acceptance rate drops drastically after more than two strategies are used. You
That
can
makes
see,
some, yeah, that makes some intuitive sense to me, in the sense that like you begin to feel like you're being sold to at that point, in which
yes.
it's like there's a scheme involved in this, and you don't want to be a part of the scheme. You want to, yeah. So that makes a lot of good sense.
And there is a little bit of correlation versus causation here too, with if you are an advisor using three, four, five, six different persuasion strategies, it's probably because the client is saying, I'm not sure about that. Like they're giving pushback. So you're trying to overcome their pushback by using another strategy, saying, well, also you got to take into consideration. So this is more correlation than it is causation. This isn't to say don't use six persuasion strategies. It is to say after two, your odds of convincing that client are drastically reduced.
That's interesting. Good point.
So I talked you through two of those persuasion strategies. Here are the six most common that we analyzed. On the left-hand side, it says the advisor provided historical market data and stats. So if I'm trying to talk you into equities, I would provide historical market data and statistics around equities and try to position it in a way that gets you to invest in an equity. So here are the six. I won't talk through each of them, but the only one across I want to say we analyzed 3,000 conversations, but I'll check on that. Across all of the conversations we analyzed, only one of them was uniquely successful, meaning that in combination with other strategies and alone, it was it had a success rate that increased the odds of somebody accepting it. This is a little counterintuitive. You would think that you could employ any of these strategies and a client could be talked into an asset class or an investment. But the only one that worked was an advisor suggesting some type of systematic investment approach to the product. So saying, hey, this is a great investment, and here's how I would suggest investing in it. Doing a DCA, or you can invest in it every week. We'll do a monthly investment, right? That's a systematic investment approach. Or we put 10% of this in there now and 20% of that in there later. Those are systematic investment approaches, some kind of strategy that isn't just, hey, you should invest in this today, but taking some kind of strategic approach to investing in that asset class. That changes per asset class, but I think it's a good representation of clients, I think, respond to some type of intelligent strategy behind the proposal. They don't want to just plug and chug. I don't want to throw money into an investment, no matter how confident the advisor is in it, unless I feel good about the approach we're taking. So let me pause. Is that understood?
Yeah, it is. I do wonder, and you're saying that's across asset classes, not just alts. Is that correct?
Across
Yeah.
every asset class.
Yeah, that's really interesting, and I just wonder psychologically if part of that is that when an advisor comes to the table with this sort of prescribed strategy, once
Mhm.
again it gives you that confidence that they sort of they have a plan, and they sort of maybe know a little bit more than you, and
Yeah.
it's simple enough for you to
Yes.
also understand, right? It's not so complicated that you can't understand it. They have a plan, and you can trust them, and so there's just kind
Yes.
of psychologically that makes a lot of sense.
I think that's right. And honestly, I hadn't thought about it too much before, but that feels right. That if the advisor tells you the process expectations and has a lot of thought behind how to do this methodically,
Hmm.
not just let's invest in this today, but hey, here's what I recommend doing X, Y, and Z, and over the course of this time period. I think it's easier for the client to feel confident about the approach. It's a
You
operational transparency, if you will.
Yeah, absolutely. And you've talked a lot about complexity, and I do think that there's
Mhm.
the theme of complexity is a really interesting through line with this, and that like too much complexity overwhelms, it seems to overwhelm and make the client suspect,
Right.
And if it's too simple, then the
Yeah.
client doesn't see they're getting their worth, right? They don't
Mhm.
get to see the value in it. So there's this
Yes.
meeting of enough complexity where they see and then they see that you've got a structure, you've got a plan, you've got a method, but
Right.
they understand it, and it's not like it doesn't feel like they're being played, right?
Right. It's almost complexity during the process, simplification during the product proposal.
Interesting,
Clients
yeah.
don't understand different asset classes. That's why the advisor exists,
Hmm.
right? But they do understand a process. Like if you're trying to talk me into something, right, I understand why I should do it, other than the ROI associated with it, right? All else equal, okay, now you're trying to talk me into actually doing this thing, making this action, committing to this behavior. You're going to have to come to me with a little more than just we
Do
should
it.
do this because
We
like
should do this, right?
yeah.
No, that
So
makes sense.
we took that a step further. Those were the six individual that we analyzed, right? But they can be used in combinations with each other. Oftentimes they are. Almost never are they used alone, although I'll get into two instances where they are here. Now we looked at all of the combinations of different strategies employed by acceptance rate. What we found was emotional appeal, if it's used alone, is the most successful strategy. That is going to be counterintuitive because I just told you in the slide before that the systematic approach was the only one that was truly successful in every iteration or most iterations that it was
How are we
approached.
defining emotional appeal? What does this sound like?
That sounds like you're appealing to the client's emotions or their family values and connecting the asset to those emotions and family values. That's how we described it for the LLM. And AI is making the determination of if the advisor did or didn't do that. Now,
So
before when I
what,
said
like, just to, so it would be something to the effect of, you're really nervous about the market. You want securities. Let's look at T-bills. Is that the kind? Would that be an emotional connection?
where we often hear this is you have a fear of legacy, right? You are afraid that you're not going to have money for your kids, for your spouse when you pass on. That is why you need to invest in an annuity. It guarantees X, Y, and Z. That's how emotional appeal is employed. And on the slide before I showed you, and I'll flip back to it, that one, emotional appeal, reassurance, empathy, is negative 4.3%. But that's when it's used across all of its instances. This is when it's just used alone. So if you're going to try to appeal to somebody's emotions, what this says is don't combine it with other sales techniques, right? If you're gonna do it, just do the emotional appeal. Just appeal to their emotions. Don't also try to talk about their, historical data of the market or try to do a systematic approach. This only works if you're doing it alone. I think it speaks to like the authenticity of speaking about emotional appeal. Like if you try to package it with other sales strategies, it might seem too salesy, like almost a car salesman
Right.
strategy. Like you're trying to hit me with the 1-2 punch of making me feel emotional and then talking about why it's right for me in an ROI perspective. So that's what this says. Now, across the board, emotional appeal, because of all the instances it appeared at, was a negative, had a negative relationship in comparison to the baseline. That's why it shows up here as negative. But when it's used alone, it's the most successful.
It's
That's
wild.
very interesting, right? In combination, it doesn't work well, but alone, it works very well.
Yeah, this is fascinating. I mean, there are, I mean, I guess I would pause to say there are so, we would have to lay out so many qualifiers. There's just so many different aspects to each of these meetings. So this is just kind of looking at a very specific, I mean, you're talking about causation and correlation, right?
Mhm.
It, it's tricky, but yeah, this is, I mean, fascinating.
So the last few things that we did was first we looked at, okay, there are now different persuasion strategies represented on the y-axis and different market outlooks represented on the x-axis. We wanted to see if you combined a persuasion strategy with a certain market outlook, what impact it had against the baseline acceptance rate. What we found was I'll give you one instance. Emotional reassurance, one we just spoke through,
Hmm.
right? If you appeal to their emotions, that works best if the client is cautiously optimistic. Most clients that we analyze were cautiously optimistic or in that range. It does not work well if they're confident. So if a client is overly confident and then like almost like riding a high about the market, is ready to make a decision, and then you hit them with, and here's why you need to do this, right? Here's the emotional value behind this. It does not work well at all. You can see almost all of the persuasion strategies do not work well with confident people.
You
What
just need to
this
get out of
tells
the
us,
way if they're confident. You just,
exactly.
yeah,
Don't sell somebody who wants to stop selling, right? If
right.
somebody's confident and you try to sell them, now they're going to be like, why are you doing this? Right? Why are you trying to sell me so hard? All you could do is hurt yourself in that instance, except for when it's a systematic approach, because we just talked about this. A systematic approach doesn't sound like a sale. It's saying like, here's how we should do this if we do this, versus an emotional reassurance is like super other side of the spectrum. It has nothing to do intellectually with how you should approach the investment and all to do emotionally with why you should make the investment. So this was really interesting. I think like on the right hand side of this chart, you can see only a systematic approach had a positive outcome with concerned clients, but it was also when systematic approach was the weakest. So concerned clients across the board do not respond well to any persuasion strategies, and neither do confident clients. So the middle, which is where most clients live, is really when you want to start employing persuasion strategies with the cautiously optimistic to uncertain. But the ends of the spectrum you typically want to avoid, definitely with confident clients, and maybe not waste your time with concerned clients.
So, okay, what happens then if the market is just genuinely cruddy? I mean, we're not there right now, but what if we're looking at this data, right? Like, if the market is genuinely cruddy and it's obvious that it is, right? Like,
Yep.
what is an advisor to do at that point if none of these strategies? And maybe we need to look at this data later when the
Yeah.
market shifts, right? Because I do think if you've got a fairly sophisticated investor that's talking
Yep.
to their advisor and understands that the market is not great,
Mhm.
then I would imagine that they can still be convinced of certain approaches because they sort of get it. I don't know. What do you think?
It's definitely client specific, case by case, but generally, yeah, we'd rerun this. We'd see the distribution will change among confident to concerned clients. The outcomes shouldn't change. It will just be much more clients are going to be concerned or uncertain, but they'll make decisions in the same way that are represented on this chart.
Okay.
So but it's true. We should look at the data at a different point in time, rerun this analysis, and see how this matrix changes if the market's not at an all-time high. I will say, for the market being so high, it is abnormal that we didn't see more clients in the confident and cautiously optimistic. This is a very weird time in our country's market
Yeah.
history where we are at all-time highs, but consumer sentiment, although it's increased a little bit month to month, is lower than it is at previous points in history. That consumers' outlook is, as we've described here, but not great. People are almost waiting for the other shoe to drop. They're like, how can this be sustained when we have tariffs and inflation and this, 100 out of 100 economists 3 months ago said there'd definitely be a soft landing type of recession. How can we not expect the market to drop? So it's an interesting time, but I think you're right. Rerunning this almost monthly would be wise and would reveal some differences in market outlooks at different points in time.
Well, this is great. Thank you, Liam.
Last thing is we looked at the market outlook against different asset classes and saw, did recommendation or proposal recommendation commitments change per asset class if the client had a different market outlook? The answer was obviously yes. The biggest changes took place in alternatives and annuities. This is something you probably suspected, but alternatives, when the confident was client, or when the client was confident, they accepted the recommendation 50% of the time. When the client was uncertain, they only accepted the recommendation 28% of the time. So almost double the amount of acceptance based on the market outlook. For cash, that variance is much less. It's not double. It's, looks like 15%, right? And from 56 to 71 relatively, that would be, I think, 30% change versus a 50% change in alternatives. Equities, 46 to 64 was pretty significant. Bonds, right, is the least amount of change, right, from 42 to 56%. Or I'm sorry, real estate actually looks like the least amount of change, 47 to 58%. So real estate's not really impacted by general market outlook, right? People are either going to buy or sell it, and that's because of a number of different factors, right? Things like when you sell your home, when you're moving, why you need to buy a home, those impact real estate as well. Alternatives, though, this was the big takeaway. If you are uncertain or concerned, you are much, much less likely to invest in the asset. So it's more important for an advisor to try to change the perspective of the client's market outlook than to sell them the product right away. If they don't do that, you've got a 28% chance of success of getting that client into an alternative if they're uncertain or concerned.
Interesting. That can help shape a conversation for sure, and what you need to sort of address before getting into the sell. That's great.
Yes.
Well, thank you, Liam. This is really fascinating. Any final thoughts to leave us with?
No, I think it's extremely interesting the way that alternatives have shifted. We will keep an eye on it and come back to this in the next quarter to see how the data has changed. And then we'll update it, and maybe we could talk about it then.
I love it. All right. Well, thank you so much. Really appreciate it.